Hello everyone, this is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me on this edition of Macro Mondays. This is being recorded on the early evening of Monday, February 24th, 2025. And in this video, we're going to talk about the gold stocks and why they are in a fundamental sweet spot right now. And gold stocks, they've been lighting it up operationally, and my tie here signifies that for this video. But that aside, let's get to the video and the charts. So starting off here, we have the gold price against the all-in sustaining cost of producing an ounce of gold for the industry. That is in blue, a gold price here in yellow. And we can see recently, I mean, this goes back to 2012, again, 2011 to 2023, that was a secular bear market in precious metals. I mean, maybe you could measure it 2022, or other people will measure it until the breakout at the beginning of 2024, but we were in a secular bear market during this time. Now, more recently, we can see, yes, there is a huge margin where the gold price is really accelerating in costs, and I think this is quarterly data here, and costs, yeah, they did go up quite a bit in the last couple quarters here, but the gold price has made a more accelerated move. So therefore you have a big margin. So this is a big margin. I would have liked to see maybe a chart with percentage, because if you're looking at, or even a chart that goes back before 2011. So this is a nice chart, but it doesn't really give us enough historical context. I mean, we can clearly see here, again, big margin here. We can go back and look at, we have to eyeball it, look at these other parts. I mean, 2022, this was showing the price here. What is that? We could call it 1600, 1650. At one point, 1200 was the cost. So around here at the 2022 low, you had $400 or $500 of margin. So now you have $1,400 of margin. That's great for the companies, but this doesn't measure share dilution. And we know that gold stocks have a lot of share dilution and a lot of debt issuance. But as far as looking at a chart that shows more history, well, I did some Googling, and this came right up in a couple seconds. Someone did post this on Twitter. I apologize for not mentioning them. I'll retweet this later. But we can see same chart here, although these are annual costs and annual prices here. And we can see this is interesting. Remember the 2020 to 2023 period where the gold price did not make progress while it was building the handle on that cup and handle consolidation. But look how much the cost went up. So that's why the stocks went down. Remember, the stocks follow margins. I saw a comment today, or a tweet, about a video where Ross Beatty was saying, the stocks are trading like gold is 2,900 and not, or they're trading like gold's at 1,800, not 2,900. Well, it has to do with the margins. The gold stocks follow margins. They don't follow the price of gold, although the price of gold obviously contributes significantly to margins. But anyway, I digress. So you can see here, we go back to 2010, 2011. I mean, we can see this was a huge amount of margin here. I'd like to see the percentage before looking here. 1,600, what is this, 900 or so. So that's almost a 50% margin. Where are we here? Okay, well, this doesn't show this year, but if we go back to the last chart, we're getting close to a 50% margin. So clearly this is a good time for gold producers. But the real question is this going to continue? Are we not coming into some kind of a peak? Like, are we coming up on a 2020 peak, or even like a 1980 peak? And I'm just talking about margins, for example. Now, obviously, if you follow my work, the answer is no. We're not coming up on a significant peak at all. And I'll get to the reasoning. First, I mean, this is technical, but so if you follow my work, you know that the gold stocks, this is a Barron's Gold Mining Index here, follows the inflation-adjusted gold price really, really closely. You can see here, looking at these two charts. I mean, I want to say they're almost identical, but they're pretty damn close. They're close enough. And the reason is gold divided by CPI inflation is the best indicator of margins for miners. And the reason is CPI inflation does a good job of mirroring, or indicating, I should say, the cost of production, the cost of mining, and the inflation adjusted gold price. Okay, this is monthly data here. It's a monthly chart. I mean, this is breaking out. It looks like a huge cup and handle. I don't want to, debate the merits of that right now. But this is a massive 45-year base that on a monthly scale is around an all-time high. So the setup on this chart is fantastic. If this chart really plays out as it should, you're going to see this thing really explode. And the gold stocks, they're going to explode past this 45-year base as well. So that's presuming we get a huge breakout and follow through in the inflation-adjusted gold price. Okay, next chart. Where are we? Now, as far as the short term, like if we're looking at short-term indicators of margins, I would say look at how gold is performing against oil and just general commodities. So this is gold against oil here. This is gold against an equal-weighted basket of commodities. The gold against the CRB, I mean, you can use that, but it looks too similar to gold against oil. But so these two lines, they show this first line, that was a breakout in gold, breakout of this beautiful cup and handle, breakout there. The second line, that's when gold against oil broke out. Look at this right here. That is a breakout right here from over a 3-year base. Actually, the measured upside target, what would that be? 30, what are we looking at? 14. So 45, 46, you have a measured upside target. So this thing, it's broken out here. It has more room to run to the upside. Gold, again, right here, gold against the equal weighted basket of commodities. What's a potential measured target? 170. So this is a 151, so this can keep moving. And the fact that these are breaking out of, call it 3-year type bases, you're going to see a move in these breakouts that at least runs for at least another year or two, I would say, or at least another year. You don't have a breakout from these bases and then just crap out after 6 months or a year. Like it's something that could run for a few years. So again, gold against the CPI, that's a big picture, kind of like a quarterly or annual indicator of gold company margins. This is a more, we can call it like maybe a week to week or month to month. So these aren't perfect indicators, but they are good leading indicators. And so what this tells us, gold against oil, gold against commodities equal weighted, is that gold, it appears that moving forward, the coming months and quarters, we should see gold continue to strengthen against oil and commodities. So good uptrends are in place. And that means, if we go back here, that means if gold moves above 3,000 and gets to the log target, the percent target of 4,000, that big move over the next 12 months, that could be gigantic in terms of margins. So that's why the companies are in a real sweet spot. And by the way, sorry to show this chart again, but speaking of a sweet spot, this is a technical sweet spot. I mean, GDX, XAU, GOEX, my favorite junior index, GDXJ, which is more of a mid-tier junior index, or it's a mid-tier index. GOEX would be similar to GDXJ if you took the 10 or 7 mid-tiers out of the index. But I digress. We're looking at nearly 5-year-long bases in these things. So these charts are set up for significant breakouts. And yes, we rallied up. We can see here, we rallied up to resistance. And yes, my video on Friday, I'm talking about how we're going to pause, we're going to pull back in the stocks. Yes, they are pulling back. But if we zoom out and look at these setups, these are set up for some really big breakout moves. And continue to follow the videos on the channel. I will try and document or assess when it looks like we're going to break out. But the key thing here is the fundamentals for gold stocks are really strong, and it is a cyclical industry. So you do have to be mindful. You do have to be mindful that at some point that you'll see the other side and fundamentals margins will soften. But based on what I'm seeing here, that next leg higher in gold from 3,000 to 4,000, you could see margins really expand, because I don't think oil and cost inflation is going to keep up with the potential for gold to run from 3,000 to 4,000. So that's where we are fundamentally. And, again, looking at the technicals, what I just said, beautiful 4.5 year bases in these stocks. They're set up for some big moves. So I know things are looking good in miners, but the view over the next 12 months, it looks really, really good. Things can get really, really good here. So don't be afraid of that. That's all for this video. Let me know what you think. Leave a comment. Thank you so much for tuning in, and I'll talk to you guys again soon.